the role of emotions in investing. Yep. So here's an overview. So first of all, I'm going to talk about how investment is actually emotion management. Yeah, for just I'm sure many of y'all have this inkling if y'all have ever like dabbled in stock investing, right? And second of all is I want to share about how to develop systems, like how I develop some systems for me to remove emotions from the picture. Okay, so before we dive in, let's talk about some assumptions that we have on how to make money in the stock market. So I've heard Morgan Housel, the author of the Psychology of Money, phrase this quite eloquently, saying that there's two ways an investor can make money in the stock market. One is to first is to correctly observe and then exploit mispricing in stocks, or in some particular stocks, right? Second of all, like, okay, let's just illustrate this. Let's say if you think that a stock is undervalued, you buy in, and eventually the stock corrects its own value. That's when you get paid off, right? Second of all is to hold stocks through volatility. And this is also this is banked on the fact that stocks in general go up, like especially the U.S. Stock market in generally goes up, and it goes up at a pretty consistent rate. So for S&P, for the S&P, it went up at around 11% compound annual growth rate for the past 20 or 30 years, right? So it's a pretty consistent thing, but all you have to do is to hold through the volatility. You have to be able to withstand like the drops. Like, it's not a stable 11% growth every single year. It's like it can be like 10% drop one year, 20% gain the other year, 30% drop another year, and 20% gain, 20% gain. Yeah, stuff like that. So there's an old saying, like, time in the market beats timing the market. And I think this principle number two actually helps you helps you realize the value, the earnings from principle number one, because even if you correctly notice a mispricing in a stock, the stock might still go down even further. And at a point, you have to be able to withstand that volatility. You have to be able to withstand that feeling that, oh crap, it's going down even more. Yeah. Okay. So with that in mind, the first reflection that I had on investing with emotions is that investing is actually emotional management. So investing involves stakes, right? Involves money, like poker. So I like to use a poker analogy. Like poker, like money is at stake in investing. Like, this results in emotions and self-worth being intertwined with your performance. And when self-worth and emotions and performance become connected, it's hard to be objective in making investing decisions, right? Think about it. Like, if you have ever played poker, or you have ever like tried investing or trading without real money, you know how different it is when you're trading with real money, when you're trading with actual money, that your actual net worth, right? When you see your money grow, you feel really good. When you see your your investments drop, you feel like crap. So like that tends to be the experience for especially relatively inexperienced investors, like, say, me and you. And I think this is because we tie our self worth to our performance, the performance of our investments, and I think that's not the best idea, because when you tie your self worth to your portfolio size, your performance, it's hard to be objective in making these investing decisions. So here are some examples from my own experience. Like there's the old adage, be greedy when others are fearful and be fearful when others are greedy, by Warren Buffett. And when I first read it, this seems to me like common sense. Like buy low, sell high, like why would someone not do that? This like common sense. But I realized how hard it is when I actually started playing with the stock market. Like for example, like in the 2022 downturn in the tech market, I had a few stocks in my portfolio, and they were all down like 40%. And at that point in time, everyone was fearful, and I kind of knew that objectively I should be buying more, but I just couldn't bring myself to do so because I felt so much pain in my portfolio being already down, and I thought that it might go down even further. I want to like time it properly and buy it at the absolute at the absolute trough of the like the absolute minimum point of the downturn, and that just didn't work. I just never ever got to buy at a dip. Yeah. So now that we've talked about how emotions are part and parcel of the investing process, now we want to talk about how do we deal with it. How should we move on? How should we move on from here, right? So a first possibility, you might think that now I am aware of my mistakes. I'm aware of my emotions. I would correct my mistake. I will not. I'll prevent myself from making a mistake next time. But time and time again, we show that we would not be able to do that. Like we are the same person. Like sure, there might be like you think you're different, but the next time the same scenario happens to you, you will likely make the same mistakes. So the safer and smarter way, I argue, is to develop systems to remove emotions from the process. Systems that help you make the right decisions even though you might still have the same emotions in the same situation. Yeah. So emotions can't be fully controlled, right? When we rely on systems, we can try our best, but there will always be blind spots. And so here are some things that I've tried. Okay. So first of all is owning assets that help you manage keep your emotions stable. Second of all is setting target buy and sell prices. And lastly is dollar cost averaging. Okay, so let's talk about owning assets that keep your emotional state stable. This should be a quick one. So we do that by like I've played around with like leverage ETFs like TQQQ, thinking that hey, like now there's a recent downturn, I wanna buy a leverage ETF and earn the most, right? Maximize my earning. But I realized that but because it's leverage, when it goes down, also in a leverage way. When it goes down 3x more down. So I realized that whenever the market like corrects itself by like 2 or 3%, I get super nervous, and it's super hard for me to hold on to this leverage ETF. And I usually just end up panic selling whenever it drops like 10%. And that's just a no go, and I feel like I just lose a lot of money. I lose money by doing that, and I think that comes to my point. By owning assets that keep your emotions stable. For me personally, maybe like TQQQ or like leverage ETFs is not the right choice to go. Maybe a stock or like a regular ETF is a better way to go. But maybe for you it might be different, but you have to figure it out, right? So what helps you? What's the risk level that will keep your emotions stable? It could be ETFs. You could be okay with options. That's very rare, but you could be okay with that. Or you could be maybe more okay with just S&P 500, which is totally cool. Okay. Yeah, so like the key point is owning assets that keep your emotions stable, so you don't panic sell, and so you stay in the market and realize the value of time in the market. Yeah. The second system that I've tried to do is to set target buy and sell prices. This is a fix on this is a like a reflection that I had on how to be able to realize the execute on the adage being greedy when others are faithful and faithful when others are greedy. Right. So how you do that is you have a target price for yourself. Like when you think a stock is cheap, like let's say you like the company, you think that hey, at this price point I think the price is cheap and I want to buy it. So no matter how, if you no matter at that point, no matter whether you feel that oh the price might go down even more, right? You just buy it there. Or on the flip side, let's say let's say there's a crazy market euphoria going on. Yeah, like let's say the stock market is like going on an all-time high and like everyone and their grandma is buying this stock. Let's say Tesla or like Nvidia, right? You can put a price target on, let's say, if this company hits this price point, I will sell no matter what. I will realize my earnings. I will realize my profits no matter what, right? So I think the trick for me is to place orders that last for multiple days to execute automatically by themselves instead of me having to execute them uh, myself, because that leaves some room for in my emotions to come into play. Like I might try to convince myself out of doing so. Yeah, like through my like I say it might go up even more, it might go down even more. Right. Okay. The last point I have is the last system that I have is to dollar cost average. So what dollar cost average is basically to invest a fixed amount periodically in the stock market. This is in contrast to buying the dip, or just which is like holding cash and waiting for a crash or dip in prices before you invest. So my hypothesis, after like hearing about people who want to hearing about people who want to buy the dip, or like with for a crash, is that people really love to time the market and buy the dip because first of all it makes them feel smart when they are right, and second of all it helps them get an artificial sense of safety when they feel like they time the market at a dip and it only goes up but not down after. But I argue that this is actually making you earn less money, right? Because first of all, you it's hard to time the dips well, right? You may not get it right all the time, and okay, let's say you start to get the dips right all the time. Wrong, you definitely lose money, right? If you time it wrong. If you time it right, even when you time it right, you might lose money because if you had actually these dollar cost average DCA into the market, the average price point that you buy in might be lower than the dip here, so you lose money by not getting in earlier. Yeah, so it's like there's a very narrow a narrow window for you to earn money when you're waiting on your cash and buying the dip. So I think this intuition has been uh, showcased in this article uh, of dollars and data, right? It also argues that buying the dip only works if there's a severe decline coming soon, and you can time it perfectly, which is a very narrow window to profit. Yeah. So in the article, he wrote this quote, which I fully agree with. Is so he wrote this. I wrote this post because sometimes I hear about my friends who save up cash to buy the dip when they would have been far better off if they just kept buying. Far better off meaning they would have earned more. And another quote is, "My friends do not realize that their beloved dip may never come, And while they wait, they can miss out on months or more of continued compound growth. Yeah. So I think that's the end. I hope you enjoyed this video. I hope you learned something. If you did, please help me hit the like button and leave a comment if you have any questions or whatnot. And I'll talk to you in the next video. Thank you for watching.